Here we go. Chapter 2. Group life and health. So plan sponsors enters into master contract. This feels like we've gone back a little bit. We did this page. Here we go. So types of group coverage. So you have life insurance, and you have accidental death and dismemberment insurance. You also have short-term and long-term disability insurance. You have critical illness coverage. We have health and dental care, all of which we're going to dive into much deeper tomorrow. You find that the ethics and professional practice kind of quickly goes over the other three modules, right? It's kind of a quick preliminary, and then it dives in deeper. There's some things that are more specific, like FinTrack and stuff like that, to the ethics module that the other chapters don't get into, but it does briefly go over the other chapters. The ASO, the Administrative Services Only plans. This one's kind of neat. If a large employer basically wants to self-insure, and then they simply have an insurance company adjudicate and handle the claims, right? So it's not their money that they're paying out, it's the employer's money, but there's just another company that's simply dealing with those payouts. So certificates for group insurance. So plan members have no contract. Coverage is outlined with the certificate, paper or electronic form, states name of person insured, the insurer, company, and benefits provided. Booklets provide more detail about coverages and rules of usage. Okay. This part here gets a little bit more technical. And again, as long as you know where to find stuff like this in the textbook, because keep in mind, because it's open book, as long as you know where to find the things, there's some things that you don't need to put to memory. For example, I don't remember exactly what percentage of a RIF, registered retirement income fund, you have to take out at each age, but I can remember that it's table 4.2. Right? Because 42 is the answer to life, the universe, and everything, according to Douglas Adams, the author of Hitchhiker's Guide to the Galaxy, one of my favorite 5-book trilogies. And so because I know 4.2, I can remember that, then I know where to go if I get asked, what is the minimum withdrawal of a RIF? I don't need to remember any of those numbers. I just need to know where to get it. Right? Similar to things with the guidelines and the sections and all that type of thing. If you get a question that's that technical, which I think seems unlikely, but still, at least you'll know where to go find it in the textbook, right? So the CLHIA guideline G3 section 6 says that group insured persons leave a group have 31-day conversion privilege with no medical underwriting required. What does that mean in English? It means that when you quit a job, you can take the group policy with you, right? Within 31 days, you can apply to have that taken with you, of which you would then make those payments instead of your employer, okay? Access to the policy. So the policy itself, right? The master contract is between the plan owner / sponsor and the insurer. Some provinces make it accessible to all the plan members. Laws applicable to plan members. For plan sponsors with plan members in various provinces and territories, coverages and terms may be impacted by the provincial or territorial insurance acts and the province of residence of the plan member. Termination. Group members must be actively at work for coverage to commence. Typically, the contract will state that coverage will begin after the probationary period, right? Usually 90 days. With the provision that the member is actively at work on what the contract stipulates as full-time. The probationary period is set at the discretion of the plan sponsor. Coverage terminates with termination of the master contract and or termination of employment or membership in association. Cost of benefits is generally lower than with individually owned coverage because you get to space out the risk, right? You get to diversify. Underwriting is generally not required for larger groups, right? Spreading out the risks allows this to happen, right? So they can spend less time underwriting. Individual and group accident and sickness insurance covers risks associated with accidental death and dismemberment, disability specifics, drug insurance, critical illness, long-term care, right? And again, we're going to get into all those details if those are new for you on Tuesday, tomorrow. So with accidental death and dismemberment, covers loss of life and loss of limbs or loss of use of limbs from accidental means, right? There is a lot of exclusions when it comes to AD&D. One of the reasons why it's so cheap is because the probability of it paying out is fairly low, right? So the death or loss from sickness or illness, bodily or mental infirmity or disease, suicide or self-inflicted injury, war, declared or undeclared, riots or insurrection, events involving driving while intoxicated or under the influence of illegal drugs, poisons, or sedatives, events involving commission of crime, extreme sports, certain surgical mishaps. These are all exclusions to AD&D. Right. And again, due to these exclusions, processing of claims may be delayed due to required investigation. Also, as we'll say in future slides, is that the loss needs to occur within 365 days of the event. So let's say, for example, somebody gets into a car accident and they're in a coma, right? And the parents finally decide to say, unplug them 15 months down the road, and then they finally pass away. Well, guess what? The AD&D portion of the life insurance would not pay out. Even if that car accident was an accident, they didn't actually die within 1 year of it. If they unplugged them at 11 months and they died within that next month, then sure, then they would be covered. Or maybe you get into an accident and your leg gets infected and you get gangrene and they have to amputate it. Well, as long as that amputation happens within 365 days of whatever event was the accident, then it's covered. If it's not, then it's not covered, right? And it's too far away. So disability specifics can be very complex. Coverage goes into effect with policy delivery and collection of first premium. May be able to increase coverage with a future income option that is added to the plan as a rider with some plans, but built into some higher end plans. You have drug insurance, can be purchased on a standalone plan or as part of a group plan, right? All right, next slide is a question, and it's going to Dina. Are you ready for the next question, Dina?
Yes.
All right, here we go. What is the purpose of the future income option?
I'm going to go with B.
Offset inflation.
It's either B or D.
Okay, it is actually C.
Oh.
So with future income option, this is something that is great for younger clients. And so if you know that their income is going to be growing over the years, right? Then with this one here, as long as they can prove that their income has increased, they can increase what the coverage is, right? Without having to be re-underwritten. You basically just say, yep, here's my paychecks. I've gone from making $50,000 a year to $100,000 a year, or to $200,000 a year or whatever. And then say, oh, okay, we'll increase your life insurance accordingly. So that's what future income option is. Yeah, thanks. All right, next question goes to Gary. You ready for this, Gary? I haven't given you these answers yet, so this might be a shot in the dark.
Go for it.
All right, here we go. What are the 4 main illnesses that are covered by even the most basic CI policy?
Oh boy.
I know it's not an easy one.
No, this is going to be a guess no matter what, I think.
Can you eliminate any of them, do you think? Which ones do you think were more popular?
I would think the sudden type ones.
Mm-hmm.
So I'm leaning towards the ones that start with heart attack because of that.
Mm-hmm.
So if that's the case, then I might take out A because diabetes is not sudden,
Mhm.
and I might settle on D. That would, I think, be my rationale.
Well, congratulations. You got it correct.
It's a fluke, but I'll take it. Thanks.
Perfect. So I do recommend for everyone to put these four to memory, right? So there's a long list with advanced critical illness policy, but even the most basic one is going to cover heart attack, stroke, heart bypass surgery, and cancer. Okay. There we go. So critical illness, usually diagnose of terminal illness and survival of 30 days. So here's the thing. If you're waiting until you are within 30 days of death before you go in to get diagnosed of cancer, your critical illness will not pay out, right? They want you to go in for regular checkups and to stay on top of your health condition, okay? So I remember one of my friends, she was a specialized, she was a holistic nutritionist. And she told me this quote that I always love. She says, you can either listen to your body when it's whispering, or you can wait until it's yelling. And I've always liked that idea. You know, so often people have these health conditions that show up and they're like, well, you know, I never really paid attention. You know, I noticed that there was like slight uncomfortableness, but I just kept ignoring it. I'm like, well, that's your body listening to it. It's not saying that you needed to be a hypochondriac and overreact to everything, but maybe pay attention. What does this mean? You know, what does this mean? You know, and learn how to speak body. You know, how is your body trying to communicate? And if you've waited until you're within 30 days of death, odds are you missed a lot of clues that your body was saying, hey, the check engine light is on. You might want to get something looked at, right? And so I think it's just kind of and again, I don't know for sure, but I think that's kind of the way the insurance companies just are promoting and encouraging people to kind of stay on top of that, right? And again, it provides a lump sum payout. So if you qualify for your critical illness, you just get a paycheck, right? It's kind of like getting that mercy paycheck from your life insurance, but this is the purpose of this, right? You get diagnosed with one of the things that qualifies, you survive the 30 days, here you go, here's a check. Sorry that happened to you, spend it on whatever you'd like. Reading another one, if an insured survives for only 15 days, will the beneficiary be paid? No. They need to survive 30 days. Yeah. Sounds good, FaZe. So basic plans cover those four main conditions, right? Heart attack, stroke, heart bypass surgery, and cancer. Hopefully you remember that. So who can remind me again, what were those for? We've said them twice now. Anybody want to take a stab at it? Go ahead, Jason.
Heart attack, stroke, bypass surgery, and cancer.
Nice. 4 points for Jason. I hope somebody's keeping track of points. Awesome. Thank you. So the comprehensive plans, they can have somewhere between 25 up to 30 other conditions, right? So you can really get some that cover everything under the moon, right? Some require more than 30 days survival before payout, right? So obviously the premiums hopefully will be a little bit less for that. Some of them might have a 40-day payout or an 80-day payout. I don't know what other numbers are. Some plans also carry a return of premium rider, right? So Shuji asked if you die within those 15 days, right, will the beneficiary get paid? Not that lump sum, but if they have a return of premium rider, right, then they might get paid out the premiums, right? So everything that, at least that part, gets paid out. And again, this would require naming a beneficiary. Otherwise, it's going to get paid to the insured, it's going to go to their estate, and then it's going to have it's going to be exposed to the three vultures. So just to reiterate on that, who can remind me who are the three vultures that I keep referring to?
Well, taxes would be one.
Yep.
Probate would be the other. And I'm just going to say your beneficiaries.
Kathy's helping you out in the chat.
Oh, creditor.
Yeah, exactly. Creditors or debtors. Is that what you're going to say too, Gary?
I was going to say debt as well, but Yeah, I wouldn't have remembered the probate one.
Perfect. Perfect. Yeah. As long as you get those three in your brain, you'll be like, yeah, the probate, the taxes, and the creditors, those three need to be paid before anybody else in your will gets any money. Right. So, and I always picture, I don't know if it was it Dumbo, like back in the 80s when there was like those three vultures that were sitting on that tree. I always picture that, there's just these three ugly vultures. And they're the ones that get to eat first. And if you've ever seen a vulture up first, they are so ugly. Like down at my place in Costa Rica, there was these vultures that would fly overhead, and every so often they would fly down low enough to where you'd actually see their faces. And I seriously felt like they were like the Death Eaters in Harry Potter. Like they were stealing part of my soul and they went away. Like their face is just so ugly. They are a menacing looking creature. I'm glad you don't often see them until you're dead. Yeah, that's often how we picture the CRA. Exactly. Exactly. I'm with you. All right, looking at long-term care. So when unable to care for oneself, this insurance provides payout to pay for care needed. Usually payment is based on when there's a loss of daily activities, right? So the ADLs, activities of daily living, right? So these are things like feeding yourself, dressing yourself, bathing, mobility, toileting, right? So, and this requires one or two medical professionals to provide proof of loss of ADLs, right? So it needs to prove that you can't do these things on your own, right? All right, covers cost of services. So like nursing home, rehab and therapy, personal care, homemaking. And again, the waiting period can be anywhere from 30 to 180 days. All right, just to make sure people are following along, here's a question for you. Which policy would have a lower premium? One that has a 30-day waiting period or a 180-day waiting period? Which one would have a lower premium? Carolyn's going 180. Perfect. 180, 180. You guys are right on point. Excellent. Some people get that mixed up, so I figured I'd throw that out there in the beginning, making sure everybody's on the right page. Perfect. So parties to the accident and sickness insurance usually bought on yourself, right? Usually it's not a third party. Go ahead, June.
Oh, hi. Can I just stop you there? I'm
Please.
just been sort of in and out throughout the day. Just curious to know what our waiting period is, and is that specifically to and such?
So every policy has a waiting period, although
Okay.
even though it could be 0 days, it's
Okay.
still going to state it in the policy. So the waiting period is once the event or the situation occurs, how long do you have to wait before payments begin? So with long-term care, it's how long do you have to wait before these expenses are being reimbursed? With disability, it's how long do you have to wait before your income is subsidized? Things like that. Obviously, there wouldn't be a waiting period with life insurance because you're dead, right? It's just
Yeah.
once that investigation is complete, then that's done. So, yeah. Does that answer the question?
Yeah. So you said the premiums are higher when it comes to 180 days because you waited that long for it. Is that correct? Is that part of the answer question that you were asking?
The other way around. So
Other way around? Okay.
So it's basically, you should be advising your clients to have 6 months, like 3 to 6 months income set aside, right? If they only have 3 months set aside, right, then they have to live off their own savings for those 3 months before the benefits kick in, right? So you'd have 3 months savings put aside, the 90 days. If they have 6 months put aside, well, now they can wait 180 days living off their own money before the insurance company has to pay, meaning the insurance company doesn't have to pay out for 6 months instead of 3 months, which means that the premiums are going to cost less. So the sooner that you demand them to start paying, the higher the premiums are going to be.
I see. Perfect. Thank you.
Sorry.
Go ahead, Gary.
Practically, Tyler, in terms of recommending one way or the other to a prospective client, would the premiums be anywhere near the cost of these types of services if they did not have the savings and had to wait for 6 months? If they couldn't afford the premiums for the better coverage, would it justify waiting or not waiting, I should say?
Yeah, like setting it up so that they can make the payments obviously makes sense. And there's different ways of how to adjust that. My thing would be the first thing to do would get insurance in place, because in the event that tomorrow something horrible happens, what's the best plan, right? Having insurance in place is going to be the best plan. And then anything that they can would be towards growing that 3 to 6 to eventually, hopefully 12 months of savings put aside, right? And some of the, especially in the beginning when I first started in this industry, is I spent a lot of time, because in the beginning, you're going to attract your peers. And when I was in my early 20s, most of my peers didn't have a surplus of money. So a lot of it was just simply dealing with budgeting, right? Figuring out, okay, how do I change their mindset so they don't feel like they have to live on everything that they make, right? That the power of delayed gratification and the importance of that as well. And so there's a lot of reprogramming that I had to do with my clients in the beginning. And then once you kind of get to that point and you've worked your way up, then obviously it makes it a little bit easier when you're meeting with clients who already have a surplus to invest. But in the beginning, I think of it as, if they were to get hit by a car tomorrow, if they were to be diagnosed with cancer tomorrow, what's the best plan that I could get set up for them now? And then work on improving the rest of it.
Thanks, that's right.
Yeah. Go ahead, June. Are you still unmuted from before, or was there something else?
Oh, I didn't realize that I was not on mute.
Okay.
Sorry.
That's okay. Just checking. Want to make sure you get heard. So parties to the accident and sickness insurance is way less exciting than a party for A&S insurance. Anyways, so you buy it on yourself. It could be a third party when bought by a corporation or partnership to fund things like key person needs, partnership agreements, shareholder buyout on disability needs, right? All rights are governed by the policy, but influenced by provincial acts, right? Payout and use of funds could be subject to corporate or partnership agreements, right? So how that money gets spent, depending on how the policy is set up, right, could get a little bit complicated when you're looking at a third party A&S. So some of the periods that it talks about, I found it was kind of confusing and they were scattered throughout the textbook. So I've consolidated them to one slide of what the periods are. So you have the grace period, the 30-day after you miss a premium payment. Probationary period, right? Typically 90 days after you start new employment. Waiting period, the time between making a claim because you're injured and once the benefits begin. The elimination period, the time before a new employee is added to group benefits, right? Also often referred to as probation period, just to make it more confusing for you. Limitation period, the time frame during which a court action must be started or the right to sue is lost forever. Guarantee period, in regard to an annuity, the time in which payment is guaranteed. If the annuitant were to die during this period, the remaining payments would be made to the beneficiary. The contestability period, also, but not as often, referred to as the statutory period, is the first 2 years of a policy where a misrepresentation or concealment other than age that is in good faith, if discovered by the insurer, could result in the insurer canceling the policy. Qualification period, the first 30 days of CI policy, which excludes any condition which is first diagnosed or which first manifests itself. Conditions after the 30 days would be covered, right? So that's the qualification period. I'm not sure if you guys want to take a screenshot of that one or not. All right. So looking at statutory conditions, right? So the insurer must issue a policy that states sufficient description of insured and person insured, the amount and method of determining money payable and condition under which payment is required, the amount of premium and any grace period, if there's any reinstatement conditions, terms of coverage and effective date of coverage. Okay? All those are going to be very clearly stated on the policy. Annuities, right? A little jumping around a little bit here. So I had a student explain to me, he says, I finally understand term annuities. I said, oh yeah, how is that? He says, they're like a mortgage. And I'm like, okay, I haven't made this connection yet, and I don't know what you mean. Tell me, how are they like a mortgage? He says, well, you go to a bank and you borrow hundreds of thousands of dollars to buy your house. So you borrow hundreds of thousands of dollars from the bank. They give you hundreds of thousands of dollars. You promise to pay them back a fairly small percentage, right? Usually the rates now are pretty reasonable, right? It combines principal and interest. And you have that money until the mortgage is to be paid back. Like, let's say it's a 25-year mortgage. You get to hold on to their money for those 25 years over those payments. They can't come after you and say, hey, I know you're only a few years into the mortgage, but we need $100,000 of that back because we're doing an expansion on the bank, right? They don't have that right to do that. They have to let you keep that money for those 25 years, right? Unless, of course, you default on the payment, then there's other consequences. And I said, okay. I said, so how's that like a mortgage? He says, well, it's like a mortgage, but you're the bank. He says, you give hundreds of thousands of dollars to an institute. They promise to pay you back principal and interest. And if at any time you want to either change the interest rates, you can't. If you want to change the payments, you can't. And if you want to withdraw, say 100,000 of your hundreds of thousands of dollars that you invested them back, again, you can't. It's like you lent them the money for a mortgage and you're locked into it during that, whatever that time period is of the term of that annuity, until the principal and interest has made its way back to you in payments. You can't cancel it or undo it. I said, oh, that analogy does make sense. It gets a little more complicated with a life annuity, but it's a pretty good comparison for a term annuity, right? But you're the one giving that lump sum of money instead of the bank, right? So I thought that made sense. So income contracts issued by insurers and other financial institution. There's a life annuity, which means that it's payable upon until death, right? So they divide it up until your life expectancy, but they keep going, right? They'll continue to pay even if your life expectancy is 85 and you live to 185. They cannot stop paying you as long as you're alive, okay? So that part there is a little bit different than the mortgage comparison. And again, life annuities, think of it the fact that it has the word life in it, so it is life insurance, right? So only life insurers are allowed to offer life annuities, right? It's a life insurance product. The term annuities, they can be sold by any financial institution for a fixed period of time, right? Annuities can be sold as group or individual contracts. Annuities can be either registered or non-registered. They can either be immediate or deferred. And all of Wednesday, which is our segregated fund day, all of Wednesday is going to be dedicated to this. With registered plans, you can have all that alphabet soup in regards to annuities, the RSP, RIFs, TFAs, et cetera, et cetera. Annuities are issued as GIA, which means guaranteed interest annuity. So just like a GIC, right? When you buy it, you know what the interest rate is when you bought it, and that is what it is, right? And the same thing with an annuity. When you buy it, you say, yep, I'll take that 3% annuity, done, locked in, sealed, ironclad deal. It is 3% until it is done, right? You are locked in at that interest rate. Doesn't matter if interest rates drop to 1%, then you'll be like, yes, I got 3, right? Or if it goes up to 6%, you might be kicking yourself, be like, I got 3, right? It doesn't matter. You are locked in, okay? It is known as deferred annuity, available as segregated funds. Payout starts sometime later than 12 months into the future, right? So an immediate annuity, you can technically push it out an entire year before that first payment begins. Immediate annuities, there we go. 1 month, 3 months, 6 months, or 12 months, you can have the annuities start paying out, right? Parties to the annuities, you have the insurer or financial institution. You have the policy holder or annuity holder. Time for my afternoon coffee. Enters the contract can be a person or corporation. Annuitant or annuitant grantee, referred to as a life insured person to whom the payments are to be made. There's a designated beneficiary, so the recipient of proceeds when the annuitant dies. The owners should also name a successor annuitant. Assume ownership should owner die before payments commence. Annuities, life annuities, as well as term annuities issued by life insurance companies are treated as life insurance under the various provincial and territorial insurance acts. Okay? And if I've kind of lost you on the annuities, that's totally fine. We literally have an entire day dedicated to segregated funds and annuities. Deferred, or also known as accumulation annuities, right? This means that they're actually growing in value rather than paying out, right? So it's a savings plan issued by insurers, subject to accrual taxation if non-registered. Who can tell me, what does accrual taxation mean? That one you should know. What does accrual taxation mean?
Does it mean in this context that you don't pay taxes until you withdraw it? Or I could be completely wrong on that. Maybe it's the other way around.
It would be the other way around.
Okay, yeah.
I always look at the root word of accrual. I know it's spelled differently in here, right? But accrual taxation, meaning that you're taxed every year on that growth, right? Where the opposite of accrual taxation is deferred taxation, which is what a registered investment does. Right. So I don't know if you guys like math or not, but here's a little formula I remember learning when I was a kid. So I thought this was kind of neat. So if you take $1, right, and you double it 20 times, right? So 1, 2, 4, 8, 16, you get $1 million approximately, right? And then so let's say you're in a 33% tax bracket, right? That's going to leave you with $760,000. Not too shabby, right? 20 doubling periods, you got $1 million starting with $1. Cool. But if you were to take that $1, and this time, every time you double it, you then minus 33% taxes, right? So this is the top one is deferred taxation, and the second one is accrual taxation. So you take that $1, you double it to $2, then you minus 33 cents. Then you take that $1.67 and then you double it, and then you minus the taxes on the growth. Anybody want to take a guess what happens after 20 accrual double taxation periods?
I'm gonna guess 300,000.
How many did you say?
300.
300,000. Well, you're looking at actually 28,000. Isn't that crazy? So after taxes, both of them, you're paying 33% in taxes. So from the government's perspective, you're paying the same amount of taxes because they just look at the percentage, not the dollar amount. So both of them, you're paying 33%. One, you're deferring taxes till the end of 20 doubling periods, and the other one, you're paying taxes every doubling period. So 760,000 compared to 28,000. That's crazy. One of them could be a retirement, and the other one is a year, right? Less than a year of retirement. That's crazy. I was blown away when I figured that out. And I was one of those geeks that actually like ran the whole numbers on the spreadsheet to like actually figure out how close it was. And it's actually fairly accurate. So if you want to use this in your sales pitch to your clients, by all means, you have my permission, right? I didn't invent it, it's math. You can do whatever you want with it. But as a little bit of a disclaimer, as I like to be as honest as possible when I'm in sales, is the likelihood, the probability of having 20 doubling periods in a single lifetime is very, very low, right? You would have to be ridiculously lucky. Whatever rabbit's foot you've got in your pocket, I want to bore that. The chances of having 20 doubling periods in a lifetime is exceptionally slim, but it definitely does show a big difference between these two numbers, obviously over 20 doubling periods. Okay, so just wanted to throw that out as my little disclaimer. All right. And I lost my mouse again. There we go. So it's based on the policy anniversary. So every policy anniversary is when you have to declare whatever growth has occurred. That's when you have to pay the taxes. Withdrawal and surrender rights, right? Generally not permitted. You're locked in the same way that the bank can't come up to you and say, hey, you know that $500,000 that I lent you for your house? yeah, I'm gonna need $100,000 of that back because we're doing an expansion on the bank and we could really use that. No, they can't do that, right? The same way that you can't go to them and say, hey, you know that hundreds of thousands of dollars that I lent to you for an annuity? Yeah, I'm gonna need some of that back, right? It's not happening, right? Death is going to trigger the liquidity, right? But again, subject to market value adjustments and withdrawal fees. Okay. With segregated funds, legally known as the individual variable insurance contract, abbreviated as an IVIC, right? So those three things mean the same thing: seg funds, segregated funds, IVIC, or individual variable insurance contracts. Premiums paid are kept separate from the insurer's reserves and managed by the insurer. Guarantee at least 75% at maturity or death. The CLHIA guidelines G2 says disclosure documentation required under law, and CLHIA guidelines could be described as mutual fund sold by insurers, right? And today we're very quickly covering over this. Tomorrow's going to make Wednesday is going to make a lot more sense of seg funds and annuities. Pension products and other group annuity plans. So you have the defined benefit pension plan, a DB, meaning that's income known based on formula as stated in the pension contract, right? So it's a lot easier to promise what you're going to contribute versus what the benefit is going to be, right? Remember, the benefit is when it comes time to retirement. There's so many variable and like various factors involved in calculating what is the world going to be like in 45 years, right? What is the investments going to grow like? What is your wage going to go like, right? There's a lot of variables, right? Hence why over 95% of defined benefit pension plans are underfunded. Think about that. Over 95% are underfunded. That's crazy. That is not a small percentage, right? Where a defined contribution pension plan is a lot easier. That basically says, hey, Gary, you're my employee. I'll allow up to 2% of your income to go into the benefits package. Every dollar that you put in, I'll match it up to 2% of your income. That's the end of the guarantee. That's it. That's all I've promised. You put in $1, I put in $1. You put in $5, I put in $5. Once it gets up to 2% of your income, you can keep putting money in, but I'm not, right? Easy. Where defined benefit plan is, I promise to pay you a certain percentage of your income based on this variable, that variable, whatever, by the time it comes to your retirement. And you know how much I'm going to pay you annually when it comes to retirement, right? Way harder promise to keep track of. Pooled registered pension plan, a PRPP, right? Legislation not yet enacted in all jurisdictions. Defined profit sharing plan, right? Many people have experience with this, right? When your company, your employer is doing well financially, they're going to share those profits with you, right? That's a deferred profit sharing plan. Tax-free savings account, right? Again, most of us have a general idea with that. You put money in, you don't get your tax refund like you would with an RSP, but it does grow tax-free and you get to take your money out tax-free, unlike an RSP, right? So or an RSP, there we go. You get your tax refund from putting it in, it grows tax-free, but then when you take your money out, then you pay taxes. RIF, right? Who can tell me what is the latest age that you can have an RSP before you have to switch it over to a RIF? Does anybody know that one?
I'll take a stab at 70.
Very close. Go 1 year higher.
71, yeah.
Perfect. Yeah. Yep. And it is the end of the year that you turn 71 to be exact, right? So on December 31st of the year you turn 71, you cannot own an RSP. It has to be transferred to a RIF. Right. The other cool thing, there's a product that only got released a few years ago, and it's an advanced deferred life annuity, so an ADLA. ADLA, yeah, an advanced deferred life annuity. And so what that means is that up to 25% of your RSP, when you turn the year you turn 71, you can transfer it into this account and you can delay it to turning into a RIF until you're 85. So the same way that OAS is kind of for those who didn't win the money game, they're really kind of down and out financially when it gets to retirement. If you qualify or want to use the ADLA, that's for those who made it, right? That's for those who have enough money coming in that they don't want all the money from the RIF paying out, right? And so they want to take up to 25% of it and delay that until they're 85, right? So that's what that is. And we'll get into that again on Wednesday. Locked in retirement account. This is usually like if you have like an investment plan, like a retirement plan with an employer, right? And you quit that job and you get to take it with you, right? You don't necessarily get access to it, but it is yours and not your employer's. So they'll put that into a LIRA, right? A locked in retirement account. LIF, life income fund, right? And that wraps up this chapter. All right, so who is next on my list? We got Jason. So Jason, can you tell me, what have you learned over the last 40 minutes?
As I'm not in the industry, most of this is all new, so I've taken copious notes.
Oh, good.
And yeah, it's all new and useful for me.
Can you tell me something specific to make sure you're memorizing it correctly?
I think some of the plans you just covered, like the other group annuity plans, I've never heard of. I've heard of, TFSA and RIF and RSP, obviously, but the other ones I'd never heard of before.
Okay. Can you tell me one of them and what it does?
I think it was the DPSP was the profit sharing one with the employer.
Yeah, perfect. Thank you. Any questions? Since you say this is all new, is there anything that that you still have a lingering thought on?
I don't think so. No, I think I'm going to have to do some review, but no, I don't think there's any open questions at this point.
Okay, awesome. I always like to address things that people get caught on, because if you think of the words that's used, when you get caught on something, you're snagged on something, which means you can't move forward. Right? And if there's an idea that you're caught on, it's really hard to keep teaching someone anything if they're hung up on something that you had said previously. They're like, I still, I need to know this. I need to understand this and get past this before I can move on to that. Even if I start talking about that and keep moving on to that, but if you're still hung up on this, it's not helping you. Right. And my purpose here is not to hear my own voice, but to make sure that, this content is making its way to you. So if there is anything where I've moved too fast and you're hung up on it and you're like, I really need to get that a little bit more, like, please feel free to interrupt and say, I still don't get that. Let's break that down a little bit. If it gets too much, right? Trust me, I'm really good at time management. If it gets to the point of like, you know what, we spent too much time on this topic, unless there's a lot of people involved. And obviously this is something that more than just a couple people are having issues with. I'm good at saying, hey, we need to move on. We'll get back to that if we need to, right? So keep that in mind. All right, so let's, actually, we still got a little bit before we're into that 15 minutes. Let's move on to the next person. Jeremy, can you tell me something you've learned over the last 40 minutes?
Well, like Jason, pretty fresh to this, but yeah, I mean, I think it's just interesting to get a little bit more granular with just kind of the different, just the different types of coverages, things of the sort. So, but also even just like what Jason was talking about too, is just some of the different plans, like whether it was, I mean, it's easy to know like RRSPs and things of the sort, but just the different benefits that are there. So I've just found that interesting. Sorry, I'm just looking over my notes, which are okay, very messy because you talk very fast.
Sorry, I'll try to slow down.
It's totally fine. So yeah, no, that's yeah, I'm just learning a lot. There's just a lot to learn.
Yep, absolutely. Awesome. Cool. All right, well, I'll let you guys take 15 minutes. You can read over your notes if you want, and we will reconvene at what is that, 3 o'clock my time. So I'll see you guys back here in 15 minutes.